Hi, I'm Calvin Rose, and welcome to Market Minute.
Chairman Powell said that inflation might have peaked in March. And so you can see some of the reasons he said that. And it's a good thing that he's thinking that because we believe that the rate of interest rate increases right now is onerous for the economy. And I don't believe that 1.4% drop in GDP, even before this 50% rate hike, was a fluke. I think it's sending a real message to the Fed, as are some of these pricing indicators.
Okay, so what was Cathy Wood getting at in that little short clip you just saw? And by the way, I'll put the link to the entire video down in the pinned comments if you'd like to watch the whole thing. And look, the reason I'm showing that is because it really plays into what we're seeing with our metrics here and how the market has acted over the last couple of days. So let's take a look at what she said. First of all, she said it's a good thing that Chairman Powell has recognized inflation has peaked. Remember, he went from saying inflation was transitory to, oh boy, maybe it's not. I better take some heavy hand action. And now I think he's starting to recognize that maybe he's overdoing it and he needs to slow that down a little bit, but we'll see. She also mentioned that the 1.4% drop in GDP that we saw last quarter was not a fluke, and that it really had little to do with Chairman Powell raising interest rates. In fact, I'll show you that in some of the commodity pricing and some of the other issues that I think she talked about in that video. She also mentioned that inventories were growing and consumption was declining. She talked about that actually before the report came out about the 1.4% drop in GDP. So she saw that coming when apparently the Fed didn't. The other thing she talked about was that recent commodity pricing and indicators are sending a message to the Fed about inflation. Why? Because prices are falling, not increasing. And this goes way beyond commodities. New and used car sales are dropping like a rock. Prices are coming down. So there's a lot of evidence that prices are declining, not going up. And these graphs kind of show what she was talking about with reference to commodity prices. Here's a graph of crude oil, and you can see that crude oil peaked out back here in March, about $130 a barrel, and now it's fallen to $110. Let's look at gold futures. And we've been tracking gold, the risk in the gold markets, and gold has basically been at fairly high risk for ever since it peaked out back here. But you can see how much it's dropped. It was up over, it looks like over $2,000 an ounce. Now it's down to $1,882 an ounce. So again, a big drop since March. Let's look at copper. Copper tends to be representative of what's going on in the economy because there's a lot of copper used in houses. So this is really reflective of the housing market. You can see, again, this peaked out back in March and has dropped a lot since then. And if you want to see all of those sort of laid over on each other, you can kind of see how they all peaked out back here in March and they've all fallen off. What were the risks last week going into the weekend? We saw a huge run up in the markets on Wednesday. And in fact, our indicators showed that risk was going very low in going into that Wednesday. And then we had a huge drop on Thursday and another smaller drop on Friday. Well, you stop and think about it, going back in time. We've got a war in Ukraine, that's a given. But also tomorrow, Monday, May 9th, is Russia Victory Day. And I think people are worried about what Putin might pull over the weekend to make this special day so he can look good coming up on Monday. So hopefully nothing really bad or worse than has already happened will happen, and we'll get past this. So let's take a look at gold risk. I mentioned gold has been dropping. Gold risk last Wednesday, when I last produced one of these videos, was very high. And this past Friday, it was also very high. And you can see that here in the graph showing the price action, which has been dropping. And the selling pressure, the orange line, is just way up here, way above the buying pressure, which is the gray line. And you can see the 1 month trend is just going through the roof and falling for buying pressure. So going through the roof for selling pressure, falling like crazy for buying pressure. So this doesn't bode well for the price of gold going forward. Equity market last Wednesday, maybe that was premature to put this at very low risk, because the market just got hammered on Thursday and then was down again on Friday. So this Friday, I moved it to moderate, not to high or very high. And why is that? Well, let's take a look at this. So this is a chart that I showed back in April 22nd or 23rd when I produced that video back then. And you can see that for the NASDAQ, and this was true for the S&P and for the Dow as well, the selling pressure had a declining trend over this period, while the buying pressure was slightly increasing here. That says that selling pressure is running out. People are starting to dip in and buy as the market goes down. So that says that eventually things should turn around and the prices should go up. Well, let's see what happened this past Friday on May 6th. And you can see here that, in fact, when I said that equity risk was very low, this is the picture we were looking at back there. And you can see that this buying pressure had moved up above the selling pressure. But then on Thursday and Friday, it reversed. But you can see that still the trend over this entire period is the selling pressures dropping here, as you can see, and the buying pressure is still increasing. So I'm concerned about this jumping up like this and crossing over. But if this doesn't continue going higher, and in fact turns and starts to go lower, and the buying pressure turns and starts to go up, this could mean good things coming. But we'll have to wait and see. Like I said, there's no crystal ball. Look at the same chart for the Dow Jones Industrial Average. You can see that buying pressure really jumped up here and looked good, and then fell off in those last 2 days, while selling pressure dropped off here and increased in the last 2 days. But you can see that the overall trend for selling pressure is still down, and the overall trend for buying pressure is still up. So hopefully that's a good sign. For the S&P 500, same thing. Buying pressure went up here, looked good, and then fell over those previous 2 days. But again, the selling pressure declining over this entire month, previous month, and the buying pressure increasing over this entire previous month. So we'll just have to wait and see how this plays out next week. Now let's take a look at interest rates. Everybody's talking about interest rates, and hopefully Chairman Powell got the message that the Fed is being too aggressive on raising rates. And I think he did, by the way. He said that, there were a lot of people speculating that the Fed might raise interest rates 0.75%. He made it very clear they're not going to do that, which I think was a good move and an acknowledgement that he recognizes maybe the Fed's overreacting here. On Friday, interest rate risk was high, and you'll see why when I show you the chart. In fact, you could argue it's very high, but there's a reason I only made it high. And the reason you could make the argument it's very high is you can see how the selling pressure really shot up here, and the price of TLT, the 20-year duration Treasury ETF, really took a dive. But overall, the trend here over the last month for selling pressure is declining. Not only declining, but declining fairly steeply. And the buying pressure is increasing with a fairly good slope here. So unless this really, this continues going higher here and kind of gets above here, and we see and this keeps dropping so that we see a forward trend that looks like it's flipping over the other way, maybe this could turn around. I'm not going to speculate that, though, because we are in a situation where the Fed is raising interest rates. And look, we started from 0.5%, back when interest rates were at their bottom. I mean, the 10-year treasuries had interest rates well below 1%. So, They were 6% back in 2007. So we've got a long way to go before we get to sort of what most people would consider normal rates for 10-year treasuries. And what about cryptocurrencies? Now, cryptocurrencies more recently have been sort of correlated with tech. I noticed this several months ago and mentioned it on the video, but last Wednesday they were at high risk, and this last Friday they actually moved to very high risk. So this has me a little worried because they're correlated, or have been recently, with tech. I hope this doesn't mean bad things this coming week for some of the tech stocks, but we'll wait and see. And you can see why I'm saying they're at very high risk. Unlike equities and even treasuries, instead of the buying pressure increasing and selling pressure decreasing, we have exactly the opposite here. Buying pressure is declining, as you can see here with this gray line. The solid gray line is buying pressure, and selling pressure, the orange line, is increasing. So this really is not a good look for cryptos going forward. Where does this leave us? So look, I was really concerned on Friday when the market started out the day down really big, down I think 2%. But they came back and didn't close in such a bad position, given that you've got 2 days of weekend with a lot of risks on the table. So I'm hopeful, given the indicators that I just showed you for equities, that maybe we'll start to see some turnaround next week. Again, no crystal ball, nobody knows, but hopefully some good things will be coming. Let's wait and see. I'm Calvin Rose. This is Market Minute, and thank you for watching today. If you like this video, please hit the like, subscribe, and notification bell so you won't miss one of our upcoming episodes. That's all for now.